I think there is a possibility of a rally into year end, partly because the next CPI data point, which should come out just after the midterm elections, has a better base effect. First point. Second point, if the midterm congressional elections go in a way which the market perceives to be positive, I think both those events can trigger a bit of a rally into year end, most particularly as we're down heavily year to date. However, having said that, looking into 2023, the fact is the odds favor a US recession. That is Jefferies' formal call, and I concur with that. And probably the best lead indicator of the recession risk in the US next year is the collapse in broad money supply growth. In the last 6 months, M2 has not grown at all in America. Yes, I think there is a chance for a rally if that CPI data point comes out lower. What was interesting last week is we finally got capitulation on some major US tech stocks. Clearly, Facebook, or what's now called Meta, is the best example of that. But the S&P basically held up. So that shows you the market is quite resilient. And one thing we need to remember about the higher inflation, while it leads to higher interest rates, it also leads to higher nominal GDP growth, and earnings are in nominal terms. But fundamentally, if rates are going up and the Fed balance sheet's contracting and money supply growth has gone to zero, that is negative for asset prices. And in my view, before this correction is over in the US, we need to see major capitulation on all the FANG stocks. Inflation is way above the Fed's target, both core and headline. I'm just saying it could come in lower at the next reporting date, and markets like to celebrate the second derivative, but fundamentally the inflation remains way higher than the Fed's target. So the key issue for the first quarter of 2023 is, will the Fed stick religiously to this 2% target? Or will the Fed, when it sees growing evidence of a weakening labor market and a weaker US economy, in due course fudge that 2% target? In my view, they will fudge that 2% target, and that will be the real signal to buy equities. But if they continue to tighten, that is bearish. The dollar rallies in its final stages here because I believe the Fed is going to fudge its 2% target. But the oil. Now, obviously, I'm saying the US can go into a recession next year. In Europe, that's got to be the base case with the aggressive monetary tightening. That should be very negative for oil because it hits demand. So that is the risk to oil. But fundamentally, I think this oil cycle is different from or previous ones, because I believe the key positive for oil prices isn't demand, it's supply constraint. And we've had a dramatic lack of investment in energy oil in the last 5 years and more because of the political attack on fossil fuels in the Western world, which has disincentivized the oil and gas industry from investing. Well, on India, what's been amazing about India this year as a stock market is its phenomenal resilience in the face of a very weak Wall Street, in the face of record foreign selling of Indian equities in the first 6 months of the year, and in the face of a quite significant monetary tightening cycle by the Reserve Bank of India. So I think I checked the numbers today. India's down, the Sensex is down about 6% in US dollar terms. The S&P is down 18%. The Nasdaq's down 29%. So India's been phenomenally resilient. And what's happened from a fund flow standpoint is the foreigners, having sold India in the first 6 months of this year, have started to buy it back again last quarter. I understand why foreigners were selling India, because it was at peak valuations and they were putting money into China late last year. I would have done exactly the same thing because China had started to ease fourth quarter last year when the rest of the world, most of the rest of the world began to think about tightening following the Fed signal. So people went into China, but clearly the move into China was undone by COVID suppression. So right now I'm fundamentally staying overweight India. I wish I'd been more overweight than I was. The reason I wasn't more overweight was because of my concerns about monetary tightening in India. Fundamentally, India is the opposite of China today. In China, we're looking at the biggest downturn in the residential property market in China since it was privatized in 1994. That's the most important sector in the economy. In India, we're now in the second year of a residential property upturn after a 7-year downturn. That creates very positive multiplier consequences for the domestic Indian economy. We see credit growth rising, and we see growing evidence that Indian corporates with healthy balance sheets are increasingly thinking about, investing. So to me, India is very well set up, and the resilience of the market this year, the Indian stock market, in the face of very bearish global environment, tells you how good how well positioned India is domestically.